Okay, continuing with Chapter 8, the efficient markets hypothesis. We're going to look at the implications of the efficient market hypothesis. First thing we're going to do is look at a couple of different different types of trading strategies and what they imply with regard to market efficiency. The first is called technical analysis. The technical analysis is research on price trends, patterns, and so forth. And the idea is that these patterns give us information as to when we should buy and sell stocks. They use things like resistance level. It uses a level for a stock to rise above. It's unlikely to rise above that level. Support level, unlikely for the stock to fall below that level. For the most part, most financial professionals believe that technical analysis is pretty much a farce. If markets are weak form efficient, then technical analysis should not work. And for the most part, what we see is that technical analysis typically does not work on a consistent basis. Fundamental analysis is research on determinants of stock value. We look at earnings, dividend prospects, future interest rate expectations, and firm risk. The idea being that we can use public information to determine the value of a stock and determine if that stock is undervalued or overvalued as well. If the markets are semi-strong form efficient, then fundamental analysis will not be successful. I believe, and I think most financial professionals believe, that markets are efficient. The question is as to what level. If we look at different stock indexes, the Dow Jones Industrial, S&P 500, it is likely that the vast majority of those stocks are trade efficiently, and probably something close to semi-strong form efficient, meaning that it's very difficult to find undervalued or overvalued stocks. Not saying it's not possible, but it takes superior ability, I guess, is the idea. So fundamental analysis assumes the stock price is equal to the discounted value of the expected future cash flow. You should have done calculation using one of a few different models to calculate the value of a stock in your Introduction to Financial Management course. Active versus passive management. Active management or efficient markets are inconsistent with active management. If the markets are semi-strong form efficient, it is unlikely that you're going to be able to find undervalued, overvalued stocks, and so forth. Passive portfolio simply, or a passive investment strategy simply means you buy a well-diversified portfolio without attempting to find mispriced securities. An example of a passive investment portfolio is purchasing an index fund. For the most part, index funds are mutual funds which hold shares in proportion to the market index. We can buy many different index funds. A couple of examples: S&P 500, NASDAQ, Dow Jones Industrial. We can buy index funds for all of those. There are also what are called exchange traded funds. Exchange traded funds tend to have cheaper expense ratios. If you're interested in index funds, you probably be a good idea to look into exchange traded funds due to the lower cost. If you're investing in index funds through your 401k, 403b, or 457 plan, is likely you have a limited number of choices and probably very few active management choices. So, role of portfolio management and efficient markets. Touched on this before. Active management assumes that markets are inefficient. Passive management has outperformed active management over time, and especially since the financial crisis. If you compare absent of additional expenses, passive management has outperformed active management, and when we consider expenses, the disparity just increases because a typical actively managed portfolio would have an expense ratio of 1% or even more, sometimes as much as 2.5%. Passive management, investment management, is consistent with semi-strong form of efficiency. The idea being that it's difficult to find those mispriced securities. If markets are inefficient, we have inefficient market pricing. That implies that we have inefficient resource allocation. When we consider larger firms, it is likely that those markets are efficient to a sufficient level to imply that the markets are not inefficient, but that may not necessarily be the case with some smaller firms. When we consider efficient markets, we'll talk about what's called the magnitude issue. The idea being that efficiency is relative. Markets are efficient. The question being, to what extent are the markets efficient? Yes or no. That would be the binary idea. Selection bias issue. The idea being that investors who find successful investment schemes, strategies, and so forth aren't likely to share their findings with us. On the other hand, those that fail are likely to share those findings. So the outcomes we see are more likely to be failed attempts than successful attempts. We also have what's called the lucky event issue, where lucky investments receive disproportionate attention. We've all heard about successful investments at different times and so forth. If we go back to the tech boom in the late 90s, it is likely that we've all seen examples of the lucky event issue